Richard Ramsden of Goldman Sachs joins us now. Richard, what's the big sort of headline to watch or number to watch out of these earnings? The smaller banks had been the area of a lot of concern. The bigger banks seem to have been okay up to this point. So what are we going to learn?
Yeah, so I think the market's going to be focused on three things tomorrow. First, I think there's going to be a lot of focus on what's happening to deposit funding costs within the banking system. I think the good news is, the deposit instability that we saw around Silicon Valley Bank has really subsided. I think the bad news is that deposit funding costs are increasing very rapidly, for regional banks, but also for the larger banks too, and that's putting some pressure on margins. So I think there'll be a lot of questions around what banks are seeing in terms of deposit flows, as well as expectations around deposit costs heading into the second half of the year. I think the second thing is credit quality is always a focus. I think the good news is that it is a bright spot at the moment, but there will be, I think, a lot of focus on commercial real estate in particular, where you've seen concerns specifically within office, where obviously you have seen a decline in values given low occupancy rates in a number of major metropolitan centers. So again, I think people will be looking at these large bank earnings to get a read across for regional banks that have greater exposure to commercial real estate. And then lastly, I think there'll be a lot of questions.
Let me stop you there, because we've been talking that quite a bit on commercial real estate. So you're saying we're going to get commentary from the larger banks that are less exposed to commercial real estate, but have good insight into it that could move the regionals?
Absolutely. I think Wells Fargo in particular has got quite a large commercial real estate portfolio. Obviously, they're involved in a number of the markets that are seeing issues. So obviously Manhattan, San Francisco, and LA. And I do think investors will pay a lot of attention to what they're saying in terms of what they're seeing at refinancing, in terms of just ability for borrowers to meet the higher cost of repaying loans, as well as expectations around what's going to happen to loan-to-value ratios, just given the decline in office values.
I wanted to double-click on that for a moment, but you were moving on to your last point. Feel free.
Yeah, I think the third thing is regulation. So obviously after Silicon Valley Bank, there's been a lot of focus on what will happen in terms of the regulatory framework for the banking industry. There is a lot of focus on the large banks in particular. The Basel III rules are in the process of getting finalized. We saw a speech from Michael Barr recently that suggested that capital requirements are going to go up. And I think that will be a focus too, specifically around, is it going to change the way that banks think about capital returns in the near term, both buybacks as well as dividend increases? So
would you say overall there's a risk to the downside for the large banks based on where valuations are? I mean, I'm looking at the JP Morgan chart. They've done nicely since March. There's sort of a flight to size, flight to quality out of that. When you talk about the net interest margin concerns and whatnot, how should investors gauge how exposed these banks are to that?
Well, I think the interesting thing is the three commercial banks that report tomorrow, I think are all actually going to see pretty good trends, and I think, JP Morgan in particular is a bank where we do think there is some room for market expectations around net interest income to increase in the second half of the year. Obviously, they did acquire First Republic very recently. We think the market is still digesting the benefits of that, and it could be a source of earnings upside. Wells Fargo is another one, where they're previously guided to 10% net interest income growth for the year. But I do think the market believes that guide is conservative and that there could be some upside to that in the second half of the year, depending again on what they're seeing in terms of deposit flows and deposit repricing. So I think 2 out of the 3 of the banks that report tomorrow, I think are going to see actually pretty good trends, and you could actually see earnings estimates edge up coming out of that. But I do think that the early banks in the reporting season are going to see the best trends.